I'd like to welcome everyone to the class. Now, the major thing that we want to achieve here is to ensure that we know the health of our business, how our businesses are doing, and we can easily measure what's going on in our business and know whether we are in the right place or not in our business in terms of profitability, our liquidity, and the likes. So if you're joining us for the first time, my name is Feisha Obilisami. I'm a chartered accountant, a fellow of the Institute of Chartered Accountants, and I run FOPCA Consulting, a firm that is into business management and business consulting. We primarily deal with our clients' books and also help them structure their businesses for profitability. All right, so we're going to go right into the class. Good evening, everyone. Welcome to this class. I'm going to be showing you some basic things that will help you to know how to keep basic accounts. A form was sent on the group for us to provide some information as regards our own business, for us to be able to work it out together here and know how our businesses are doing. So we're going to start right now looking into some of those things that are so important to help diagnose our business. Okay, how to diagnose the financial health of your business. Diagnosing the financial health of your business involves analyzing its financial performance using various financial metrics and ratios. So we're going to be looking at some of these metrics and ratios, and I'm going to be explaining them to you because they are things that are easy to find. But in order for you to find these things, you must keep good books. This is so important that you keep good books. Keeping good financial records will help you diagnose exactly how healthy your business is. Number one, you have to gather financial statements. You request the following financial statements from your bookkeeper, if you have a bookkeeper, and if you're the one running your business yourself, right? You have to have books such as the balance sheet. This is a snapshot of your business's financial position at a specific point in time. And this includes all your assets. You know, I've noticed some businesses when the owner of the business buys, for instance, maybe they buy new tires for the vehicle that is being used for the business, they add it to their expenses as part of the expenses for that period. And it should not be, because you can use a tire for so long. So a tire should, for instance, be a part of your asset, not just a part of your expenses. You don't expense it. It is an asset. All right, so we have the assets, then we have what we call liabilities. Your assets, let me go back to the assets. The assets include the cash you have in the bank, for instance. Your bank balance is part of your asset. You have things like motor vehicles as part of your assets. You have things like, if you're the owner of the building where you're doing your business, it is part of your assets, right? So the value of these assets, right, they are in your balance sheet. Then we have something we call receivables and prepayments. Receivables are monies you're yet to collect from your customers. Let's say a customer purchased goods from you and they are yet to pay. That goes to your account receivable. That goes into your balance sheet, right? Because the money has not been collected. So it goes right into your balance sheet. So we also have prepayment. Prepayment, for instance, you know, we pay for rent in Nigeria. We pay for rent for 12 months. In some other countries, they pay monthly for rent because, of course, rent is more expensive, you know. But in Nigeria, we pay for rent on a yearly basis. So let's say that as at the time that your account is being put together, you have spent 6 months in that facility that you're using for your business. That means that you have another 6 months left. Let's say you paid 120,000 for rent. you have used 6 months. That means that you have 60,000 balance. That should not go into your expense. It should not be expensed in your income statement. I'm still going to explain some of these things. I'm saying when we say income statement, that is your profit and loss account, where you have your revenue, which is your turnover or your sales, minus your expenses. So you don't put all the rent you paid for the year. Let's say you paid in January, you now put all the rent for the year, you put it in and say, I've paid rent. Let's take that out of the revenue that we made and things like that. It shouldn't be. You should only take out the portion that you have used already. The portion that is not used goes into what we call the balance sheet, which is also the statement of your financial position, right? Balance sheet is such that it is a document that helps you when you're looking into your business. That is what really shows the state of that business at a particular point in time. When you pull it out and you begin to look at your balances, that is the sum total of your entire business, right? So then we have what we call liabilities. Liabilities are things like loans, short-term loans from the bank, long-term loans. Short-term loans can be 3 months, 6 months, 1 year. Long-term loans go for longer, 2 years, 3 years, 5-year loans, thereabout. We have what we also call your current liabilities. Your current liabilities are things like you purchased goods, but you are yet to pay. So you have what we call your account payable. All the people that you are owing that you are yet to pay, you have them as your liabilities. And then we have equity. Now, equity is the sum total of all that you, the owner of that business, has invested in that business, that has brought that business to that state. Some people don't know how much they've invested in their business so far. If some people are asked, oh, how much have you invested so far in your business? They don't know. They'll say, I write it somewhere or whatever. You shouldn't. You should have an account that shows you all that you have put into that business so far. Now, in addition to the monies you've put into your business, you've invested into your business, that's your initial capital and other monies that came in out of pocket to do one thing or the other, that forms your equity. You also have the profits that you make on your business, right? It is also added to your equity. You can see it there as part of what we call retained earnings. It can be plowed back into the business, but it shows that money was made from the initial money that was put into that business, and the money that was made, part of it was plowed back into the business. So that forms your equity. Now let's look at the income statement. This is a summary of your business revenues and expenses over a specific period, including net income or loss. I've explained part of this as I was explaining the balance sheet. Your income statement, which is also known as your profit and loss account, is one of the most important accounts because it helps you know whether you have made profit or loss. Right? At the end of the day, you put together all your sales or your revenue from the business. Then you remove all the expenses that you have made. And what you will have left is your net profit. Net profit before tax. If your business pays tax, if it's in the category of businesses that pay taxes to the government, you take out your taxes, and what you have left is now your net profit after tax, right? But if you don't pay tax, if your business is not liable to taxation, then you can go ahead and take that as your net profit. Then we have what we call the cash flow statement. It's a summary of your business's inflows and outflows for a specific period, right? So these three accounts are very, very important. Let's move to step 2 in diagnosing the financial health of your business. Step 2, analyze financial ratios. Calculate and analyze the following financial ratios. We have 4 financial ratios here. We have different financial ratios, but under 4 categories. We have the liquidity ratio. Under the liquidity ratio, we have the current ratio and what we call a quick ratio, right? This helps you to know the liquidity, how liquid your business is. When we talk about liquidity, we mean things that you can easily turn to cash. Things that can easily turn to cash. So when you hear things like liquidity ratio, is the part of your asset that you can easily turn to cash if needed. That is for the liquidity ratio. And this helps you know how quickly you can meet your current liabilities, things that you have to pay for short term. Then number 2, we have profitability ratios. Profitability ratios, under that, we have the gross margin ratio. That is the gross profit over the revenue. Then we have the operating profit margin ratio, the operating profit divided by the revenue, meaning that you need to have the figures of your operating profit. You need to have the figure of your revenue for you to be able to calculate some of these things that we're going to be going through today. Then we have the net profit margin ratio. That's your net profit over your revenue. Number 3, we have the efficiency. Now, the profitability ratio, before we go to efficiency ratios, it shows, just like the name connotes, it helps you know how profitable your business is. If that business is profitable, you will know using this ratio. If it is not profitable, you will also know. We'll also still delve deeper into this, but let's go on for now. Let me just go through the ratios first. Number 3, efficiency ratios. That's asset turnover ratio. That's revenue divided by your total assets. We talked about assets before, things like the vehicles you use, the building, if the building belongs to you, and things like that. Your revenue, what did you use that asset to make in your business? How much revenue, how much sales did that asset that you're using for the business make for the business? That is what this will show you, how efficiently you have been using your assets. Now, let's look at the inventory turnover ratio. That's the cost of goods sold over average inventory. What is your cost of goods sold? Now, let's say someone, for instance, sells purses, maybe ladies' handbags and things like that. They bought these handbags for, say, 25,000 a piece, right? And they bought 10 handbags. What's going to be their cost of sales? I want this class to be a bit more interactive. Can we put it in the chat box? What do you think the cost of sales, as per the bag, what do you think the cost of sales is going to be? This person is into sale of bags, bought 10 bags at the rate of 25,000 naira each. What do you think the cost of sales should be? This is something that every business does always. Okay, so let's see. 25,000 naira multiplied by 10 will give us 250,000. So that means that this person purchased each bag at the rate of 25,000. Their cost of sales is going to be 250,000 on the bags, right? This is quite important that you have this sorted in your business. You know, everyone does it. There's no how you're going to be running a business. You won't do your cost of goods sold. You may not know that this is what it is called, but this is what it is called. And it is one of those things that are so important. It's one of the key indices that you use in calculating the financial health of your business. Now, we also have the average inventory. What's the average inventory your business holds? On the average, what is the average inventory that the business holds? Let's say you're using 1 million and you're into sales, for instance. You're into sales and that 1 million naira, you used it to purchase goods, right? And you keep turning it over. You have some left over, you go buy some more. Your reorder quantity, you have a reorder quantity. Maybe once your goods get to maybe 10 packs or 50 packs, you have to reorder. So what's the average inventory that you carry, right? That you would normally always have in your business. It helps you to know your inventory turnover ratio. And this helps you to know how efficiently you're using the money that is in your business, the money that you have in your business, how you're able to quickly turn around your business, right? Now, we also have number 4, insolvency ratio. That's debt to equity ratio. What is debt? Debt simply means loans, right? Loans, what you're owing, what you collected maybe from the bank, could be in form of mortgage to buy a property for the business, or that debt is what you use in running your business. Because we do know that quite a number of businesses, all around the world, use debt to run their business. If you have a beautiful business idea and you're doing very well, you know that business you're going to be able to turn it over and make money. You can go for debt. You can decide to take a loan, right? And then use it to run your business, right? Solvency ratio is the ratio that helps you to know how solvent your business is. Your solvency ratio, rather, helps you to know how solvent, how stable your business is, right? Every entity wants to continue. No entity wants to die. If your solvency ratios are not good, then that means that business may be about to collapse. All right, so let's move on. Step 3, how to interpret your financial results. We're still going to do some calculations so you'll get to understand a lot better, what I've been explaining to you. Number 1, analyze the financial ratios and statements to identify the trends in your business, strengths, and weaknesses. It helps you to analyze, number 1, your revenue growth. Is revenue increasing or decreasing? Number 2, your profitability. Are you generating profits or losses? Cash flow. Is cash flow positive or negative? Because you can have negative cash flow. Number 4, liquidity. Can you meet short-term obligations? And number 5, efficiency. Are assets and resources being used efficiently? Then step 4, identify areas for improvement. We're also going to be looking into this. Based on financial analysis, identify areas for improvement. This is what it helps you to do. After diagnosing the financial health of your business, it helps you identify areas in which you need to improve in your business, right? So, based on your financial analysis, identify areas for improvements such as cost reduction, revenue growth, cash flow management, and asset management. For cost reduction, you identify areas to reduce costs and improve profitability. For example, some time ago, I think it was about a year or 2 ago, one of our clients, we noticed that they were spending so much on repairs. repairs of motor vehicles. And these amounts were huge. So after putting their records together, we pointed out this to the management and we asked the reason why they were using so much, doing so many repairs, you know. And during investigation, it was discovered that the driver in charge of that vehicle was conniving with the mechanic, to buy substandard parts. And then they tell the management that they are getting it from the dealership of that particular vehicle, which was, I think, a Toyota vehicle. They were spending so much. They will buy the substandard one, then pocket the money for the genuine one. So they'll just take out some, just buy something, repair, and then, oh, let's just manage that. And they kept buying and buying and buying and buying until, we pointed it out to them that there was something wrong with that particular cost. So during investigation, they found out, and they were able to curb that, right? They were able to curb that. Now they have somebody who checks. It is not the driver now who is the same person that is buying the parts, that is negotiating with the mechanic and all of that. All the driver does is to ensure that it is done when it is at the mechanics, right? And go pick up the vehicle. So things like that. This will help you identify areas where you should not be spending so much money, but you are, right? You can investigate those things and then begin to reduce costs. And this will, when cost goes down, profitability improves, goes up. Number 2, revenue growth. You will now develop strategies to increase revenue and improve sales performance. When you finish analyzing the financial health of your business, it will help you see loopholes, places where you can increase, areas where you can increase, where you can generate more revenue, maybe areas where you can upsell. For instance, you are into sale of food. This has happened to me before at Chicken Republic. I went there to get some things, and I noticed that the sales personnel kept asking me, would you like to have that with this and this? Would you like to have that with this and this? And I was wondering, I just want to buy this thing. And, she kept going and going. Later, I realized that they had a target and they have been trained to upsell. So aside from what you're buying, they will try to convince you to buy other things, right? You may think that, oh, my business is doing so well. We're making so much. A lot of times we look at just our revenue. Oh, I made 5 million this month. You did not make 5 million this month. The cost of goods sold is there. The expenses are there. You have to pull out all of those things. See what you have actually made. That is your net profit. If your net profit is not what it should be, and that is why every business should do a budget. At the beginning of a year, do your budget. What is your budget? What are you looking forward to? If you don't have anything you're looking forward to, believe me, you're just going to be running a business until you run it into the ground. But if you have something you're looking forward to, let's say last year you made 6 million profit. And this year you're thinking, okay, we can double our profit. You have to look at what we need to do to double our profit. If you don't analyze your ratios, you don't analyze the financial health of your business to see where you are at, that will form the basis of the budgets now that you have for the new year. If you don't have it, then it will be difficult for you to just pick up and say, oh, we did this and we're going to do that. Some don't even have books for them to know what they did last year. and what they want to do this year. What they did last month of April, and what they want to do in the month of May. You have your yearly budget, then you have your monthly budget. It's broken down now into monthly budgets. Are you meeting that budget? Right? So revenue growth is something that is very important. You have to develop strategies to increase revenue and improve sales performance. Number 3, cash flow management. Implement strategies to improve cash flow management, such as managing accounts receivable and payable. Right? What is cash flow really? It is how money comes into your business and how money leaves your business. That is all that it is. How money comes in and how money leaves that business. You know, do you have more going out than what is coming in? Right? Your cash flow can be positive and it can be negative. It depends on the kind of business that you run. Let's say somebody is running a business where they give out loans. Your cash flow management should be that you always have money to give out, but you don't have too much on hand. If you have too much on hand, where you make your profit is to give out loans. That means that you're not going to be making profit on those monies you have with you that has not been given out, right? So your cash flow has to be managed in such a way that you have enough to give out, but you don't have too much on hand that the money will eat into your profitability, right? Because the money is there for you to make money. Then asset management. Optimize asset utilization and manage inventory levels. Optimize asset utilization. Let me give you an example. Let's say you run an eye clinic, for instance, and you have bought machines worth 40 million. At the end of every month, that machine is supposed to be making money, a lot of money for you, right? But if that machine, you have calculated that every month this machine should make us at least 5 million because we have spent this amount on it, you know, a huge amount on it. It should be giving us 5 million, and that machine is giving you 500,000. That means that our asset is not being utilized optimally. You need to increase the volume, the number of customers that you're serving in that eye clinic for you to be able to now meet up with your revenue goals, yeah, which is 5 million. Let's look at managing inventory levels. In your business, you should not hold inventory more than what you ought. You should not tie down money, using your money to buy inventory that does not move. When you do your analysis, you keep your books properly, which is so important. You keep your books properly, whether you have a bookkeeper, a finance person who keeps your books, or you're the one keeping your books. Your inventory level is so important. Let's say you bought 100 of this particular goods, and just to try it out, and you saw that the goods are moving, you know, they are moving. Before you know it, within a month, you finish selling. The natural thing for a lot of people to do is go and get twice that amount and buy like 200 and keep in their shop. People are still coming to come and buy. It doesn't work like that. Instead of buying 200, you buy another, say, 50 and see whether it will still move at the same pace. Then you go back. If it moves quickly, go back and buy another 100 again and see how it moves. If it's still moving, then you will know that that particular product is something that moves in the market, and you should do your research on why it is moving. Sometimes we don't bother to check, why is this particular thing moving? Why is this one not moving? We'll just say, oh, this one is not moving anymore. This is what is moving right now. Let us go into it. Don't go with everybody, because everybody is going in a particular direction, then you have to go in that direction. If you check your books, you are able to analyze your books. You know the quantity of this you sold, the quantity of this you sold, the quantity of this you sold. You know what to restock, when to restock. You know what not to buy much of. Let's say you bought 20 cases of a particular drink and it took you 3 months to sell. The thing was even almost expiring. You have to give it to somebody at a lower profit margin so that you could get rid of it. Then you should not go back and now buy 40. No. You should either buy very little of it, maybe 5, peradventure somebody comes for it, or you stay off that particular product. It may not be moving in your market. It may not be moving in your market. So you have to do some research to know why. To know why. And there are some things that are seasonal. You buy it at a particular season. Let's say raincoats, for instance. It's about to start raining, so you should buy raincoats. If you are into sale of, things like that. Raincoats, rain boots, and things that people need for the rain, umbrellas and all, because you know that it's the season and people are going to need it, right? But in dry season, you don't go and buy raincoats. You don't go and buy sweaters. You don't go and buy rain boots. You don't buy umbrellas, because you know that people are most likely not going to buy it. Let's even say umbrellas move. Yeah, during the dry season, a little it moves because people want to protect themselves from the sun. But how many people really want to protect themselves from the sun? That number of people who want to protect themselves from the rain are more than the people who want to protect themselves from the sun, right? So let's move on. So we've talked about the assets, how to manage your assets in the area of assets and your inventory. Let's move. Step 5, you develop a financial improvement plan. Now, once you identify the areas where you need to make improvements after the analysis, after the diagnosis of the financial health of your business, you will now create a financial improvement plan, right? To address the identified areas for improvement. Number 1, you must set financial goals. Establish specific, measurable, achievable, relevant, and time-bound financial goals. All right, let's move on. So we have our SMART goals. I talked about having a budget, right, for your business. You know what it is that you want to achieve. It must be specific. On product A, we want to sell so and so quantity, right? And at this profit margin, you know the contribution that product A is going to make for you, right? Then it must be measurable. You must be able to identify the quantities you need, how it is being sold, what is coming back. That's your budget and the actual that you have. Are you meeting up with that budget that you have set? You must be able to measure it. Achievable. Is it achievable? Last year, you sold maybe 1,000 units of this particular thing. This year, You want to sell 10,000 units of this particular thing. Have you made the necessary investments to get you from that 1,000 to 10,000? Is it something you can achieve, or something that at the end of the day you find that, oh, this thing is not achievable because of this, we need this to be able to achieve this. We need that to be able to do that, and things like that. It must be achievable at the level that you are. Look at what you need to put in to be able to get what it is that you want to get. You want to move from 1 to 2 to 5. What are those things you have to put in place to get you to where you need to go? Do you need to employ more hands? Do you need to bring in more liquidity into your business, more capital, more investment into your business in terms of cash, and the likes? And it must be relevant. When you're setting financial goals, it must also be relevant to your business. It must be time-bound, right? It must be something that you can measure in terms of time. Let's say this quarter we are doing this. That is time-bound. You don't say, for the year we are doing this. No, for at the end of the year, you may even forget. But because it is time-bound, you give yourself, this month, this is what we're doing. Then we measure, it is specific, we're doing the 10 quantities of this particular thing. Maybe you're selling some machines, you want to sell 10 of these machines. It is measurable. 10 is what we're selling. We can measure, today we have sold 2. Tomorrow we sold 1. Like that. You can easily measure it. It's achievable because you have looked at your books, you have looked at everything that you need to put into it to get it done. Is relevant to your business. All those things that I mentioned earlier, and it is time bound. You now come at the end of the period to say, okay, so these are budgets, these are actual. Did we achieve our 10? If we achieved 8, what happened? Why were we not able to do the last 2? You go back again and re-strategize and then move into the next month. The next month, don't say now we're going to do 15. You have not done 10. So you want to come back and finish up that 10. You can now say next month, we're going to do 12, right? We'll do the 10 and the additional 2 that we did not do. We're going to push ourselves because now we know why we did not do the 2. So we can push ourselves to be able to do 12. Then we have number 2, develop strategies to achieve the financial goals, right? Such as cost reduction, revenue growth, cash flow management, and all of that. There has to be a strategy on ground. Yeah. Cost reduction, we talked about that earlier. I used a live example from my experience for you on that. Revenue growth and all of that. We've also explained that. So let's move to number 3. Assign responsibilities. You have to assign responsibilities to your team members to implement these strategies. If you don't assign it to anybody, nothing will get done. Nothing will get done because you can't do everything yourself, except you're the only one in the business. If you're the only one in the business, then you have to set targets for yourself, set reminders for yourself. Oh, I have to do this at this particular time. I have to do that at this time, and things like that. But when you have team members in the team, you are going to manage this. You have to check when they want to buy this. If the cost is too high, you have to cut it down. We're not doing more than this of this when we want to, let's say when we want to buy inventory, don't buy more than 10 of this, so that somebody who does not know anything about it does not come back and say, oh, we just purchased 20 of this particular thing. And you should not be buying more than 10 of that thing. It's going to mess up your improvement plan. So you must assign to everyone, train them, assign responsibilities on how to achieve the strategies that you have set, And then each team member knows what they are supposed to do. Then you monitor progress. That's number 4. Regularly monitor progress and adjust the plan as needed. Anything you don't monitor will not get done. Once you don't monitor something, it is a normal human phenomenon that people, except they are pushed, more or less will not do what they are supposed to do. They may start off well, but if they are not being monitored, they will not do it after a while. Then they'll tell you, oh, I forgot. Oh, this one, well, I'm going to do it. I'll get it done. I'll get it done. Whereas they ought to have done it. But if you have a specific time, let's say every Monday morning, you come in with your reports. What were you able to achieve? How much were you able to reduce in costs? The revenue growth, how well are we doing with that? Our cash flow management, how well are we doing with that? By the time you keep monitoring, regular monitoring exercises are taking place, it will help the business, the team, everyone, will work together in sync. Don't wait till after a month. Then you say, this is the end of the month. Everybody bring in your reports. Let's see what you did for this month. No. Do weekly reviews. In some businesses, it's important you even do daily reviews. It can just be 30 minutes. Everyone joins a Zoom link like this or Google Meet or whatever you use. And then everyone will tell you, oh, this is what I did, this is what I did, this is what I did. So that the days are not being wasted. So that the days are not being wasted. You can easily move them. If you feel that somebody is not doing well on a particular thing or they are not well suited for that role, you can move them out and move somebody else in instead of wasting time. All right. So right now, we're going to do some analysis. We're going to do some analysis, and I hope you have your forms with you. You've gotten the figures. Is there anyone you were able to get your figures together? We can use your figures to do some calculations. Or if you don't want to use your figures, you can, some people are quite private. They may not want to use their figures. So what we can also do is to run through the examples, then you work it out. You do the examples on your own side as well to see how well your business is doing, right? So we're going to start with the liquidity ratios. These ratios measure a company's ability to pay short-term debts. And number 1 of these ratios is the current ratio. Now, your current ratio is your current assets over your current liabilities divided by your current liabilities. For example, company A has current assets of 100,000. And this includes their cash. Let's say their cash is $20,000. Then their accounts receivable is, say, $40,000. And that makes $60,000 already. And then we have the inventory, which is, let's say, $40,000. So that makes $100,000. This is their current assets, things they can easily turn to money, right? Then we have the current liabilities, which is your accounts payable and your short-term loans. Your account payable could be that you bought something, you've not paid for it. It goes into the accounts payable account, your account payable, and you keep it there. That sum is there. Then you have your short-term loans. Maybe you took a loan of, say, 10 million, or okay, let's use the figure that we have here. You took a loan of, say, $25,000. Your account payable goods that you bought, you've not paid for, is another 25,000. Is another $25,000. So that makes 50,000. Now, your current ratio is going to be your current asset, which is the sum total of your cash, your account receivable, and your inventory. Your inventory is your stock you have for sale. Let's say you don't run a business that requires inventory. Your business is a service-based business. It will be the cash or the monies you have in the bank, your balance, the balance in your bank statement, and your account receivable, your clients that may be owing you that have not paid. So you put all of that together. That will be your current asset, okay, over your current liabilities, things that you have not paid for, that you ought to have paid, for, but they are still in the account, right? That's the account payable, for instance. Then the short-term loans, which may have fallen due or not. So let's look at it. Your current ratio is $1,000 over $50,000. That gives you a current ratio of 2. And the interpretation is this. Company A has a current ratio of 2, meaning it has twice as many current assets as current liabilities, right? It has as many current assets as current liabilities, meaning that this company is able to meet its short-term spendings. This company will not easily be shaken, by anything. They can't easily go bankrupt because they have twice as much of what they are owing in hand. So they can easily pay off what they are owing and still be okay. This indicates good liquidity, right? This indicates good liquidity. So let's look at number 2 under liquidity ratios. We've looked at the current ratio. Then let's look at the quick ratio. Now, the quick ratio, the reason why it is called quick ratio is because it gives you something that can give you quick cash, even quicker than the current ratio, because you may not be able to sell off some things very quickly, but things that you can easily put your hands in, things that you can easily say, okay, can I have this? And, it comes in. So your current assets minus your inventory divided by the current liabilities. Now let's look at the example. Company B has current assets of $150,000. Let's rate it again, just the same way we did the other one. Let's say the cash they have and their bank account, what they consider cash that can just be spent, that can be spent right now is, say, $50,000. Then the account receivable, monies they have out there that has not come back into them, is another $50,000 rather. Then they have inventory of $50,000. So all their current asset is $150,000. Then their inventory, we said, is $50,000, right? Then their current liabilities is $75,000. Their quick ratio is going to be 150,000, which is their total current assets, cash, account receivable, and inventory, minus the 50,000 that is inventory, because inventory sometimes can move slowly. So it may not, the cash may not come out as quickly as you need it to come, and you have liabilities to cover. Then the current liabilities of 75,000. This gives you a quick ratio of 1.33, right? The interpretation is that company B has a quick ratio of 1.33, indicating it has sufficient liquid assets to cover its short-term debt, meaning that it can cover its short-term debt 100% and still have 33% left. Okay? So this is a good quick ratio. It can be better, but this is a good quick ratio for a company to have, right? So in the event of an emergency, you have to quickly pay something. The business still remains afloat. Okay? So let's move to the next set of ratios. Profitability ratios. These ratios measure a company's ability to generate profits. Number one, the gross margin ratio. That is the gross profit divided by the revenue. How do you get your gross profit? We're going to look at that now. For example, company C has revenue of $500,000 and then cost of goods sold of $300,000. What is the cost of goods sold? I explained it earlier. Now, let me try and explain again for those of us who were not around when I was explaining cost of goods sold. Let's say you are into sale of, let's say, bags of rice, for instance, and a bag of rice sells for 60,000 naira, right? So you bought the bags of rice for 60,000 naira, and you were able to buy, with 300,000, you were able to buy 5 bags, 60,000 times 5, right? That will give us 300. So you sold these bags of rice at 100,000 each. So that gives you a profit of 200,000. Your gross margin ratio will be that 200,000 divided by the 500,000, which is your revenue. So that's gross profit of 200 divided by 500. That gives us 40%, right? So you made 40% on that 300,000. Companies, that the interpretation of this is that company C has a gross margin ratio of 40%, indicating it retains 40% of its revenue as gross profit. Now, this does not mean that that is all. It's just showing you that that business in itself is profitable when you're looking at the direct costs alone. You have to still now look at the other costs, right? So let's move to the next profitability ratio, your operating profit margin ratio. Your operating profit margin ratio is your operating profit divided by your revenue. For example, company D has a revenue of $1 million. Its operating expenses is 600,000. So its operating profit is going to be 400,000. Okay. Now, operating expenses means that your cost of goods sold has been taken out, and expenses such as salaries and other expenses, welfare expenses, medical expenses, transportation expenses, and the likes, all the things that you do in your business, the things you spend money on, that is not directly associated to the cost of the goods that you sell or the business that you run. That helps you to know exactly how much the business is making. When you take your cost of goods sold, for instance, out of it, let's say your cost of goods sold is 300,000, your operating expense is another 300,000 after paying salaries and the likes. Then you have operating profit of 400,000. Now, let's calculate the operating profit margin ratio. The operating profit margin ratio is 400,000 divided by the 1 million. That gives you 40%. The interpretation is that the company D has an operating profit margin ratio of 40%, indicating it generates 40% of its revenue as operating profit. Right? This is very important. This is very, very important to your business, because when your operating profit margin is very low, that means that that business has very little room to move. It has very little room to move. The retained earnings will be very small, is already very small. And in this case, revenue needs to increase while costs either stay the same or the cost is reduced, while revenue may stay the same or increase a bit more. And then you have to reduce the costs to ensure that this margin is good enough, is high enough, right? So let's move to the next one. Net profit margin ratio. The net profit divided by the revenue is what gives us the net profit margin ratio. For example, company he has revenue of 2 million and net profit of 200,000. The net profit margin ratio is going to be 200,000 divided by 2 million. That is 10%. Okay. Now, this shows that company he has a net profit margin ratio of 10%, indicating it retains only 10% of its revenue as net profits. For some business, this is good. This is fantastic, because for some business, they make maybe 5% of their revenue as profit. And even that 5% can be huge depending on the kind of business that you run, right? But it can be better. Ideally, a business should do something in the range of 25% of its revenue as net profit. That is a good place to be. That is a good place to be, because at that rate, the business will be able to expand better and faster, right? 10% of your net profit may not necessarily be is not good, because you may have investors that you have to pay. By the time you are paying your investors, that means that the business will have next to nothing for growth, for expansion. So the higher this is, the better, right? So let's look at the efficiency ratios now. We have looked at the liquidity, and the profitability ratios. Let's look at the efficiency ratios. These ratios measure a company's ability to use its assets and resources efficiently. Number one, asset turnover ratio. Now, your revenue divided by your total assets. This is how we calculate this. For example, company F has a revenue of $1.5 million, right? Has a revenue of $1.5 million. You know, I like this amount, $2 million, $1.5 million. These are good amounts to have as revenue in your business, right? So let's look at it. The revenue is 1.5. The total assets they used in making that revenue is 500. That is fantastic. It can even be better, but that is fantastic, really. Now let's calculate the total, the asset turnover ratio. 1.5 million, which is the revenue, divided by 500,000. And this gives you 3. That means that company F has an asset turnover ratio of 3, indicating it generates $3 of revenue for every $1 of assets. That is fantastic. It can even be better. For some businesses, it is far better, especially for businesses that are service-based, that do not really have to like buy machines, buy this and buy that, maybe, for production, for this and that. For a production business, this is fantastic if you have this for your production business. But, for some other businesses, it can even be far higher. In this day and age of remote work and all of that, a service-based business can operate from home, just paying a part of the rent and a part of the utilities. Maybe they are paying 50,000, and at the end of the period, they're not using so much. The assets they have in their business, the expenses are not much, right, for them. And the asset they have in their business, maybe their computer. Of course, you cannot measure intellectual property. You cannot measure the mind that they're using, which is like the gold mine, right? That is bringing about the value for the clients that they are serving in their business and bringing in the income, right? But majorly, they have very minimal asset costs, so to speak. They don't spend so much on assets. The assets they have is them. They continue to improve themselves and all, but they don't have to like put so much money down on machines and things like that. But for a business that is into manufacturing, for instance, your assets might be so much more. Let's say you manufacture tires, you have to buy the assembling line to put the tires together, and things like that. And that might be costing you so much. So you have to now look at what you used in purchasing that asset versus what that asset is making for you. That is what will tell you what you're making per dollar or per naira or per series of assets that you have, right? So let's move on. Number 2, inventory turnover ratio. This is the cost of goods sold divided by average inventory. Your average inventory can be calculated this way. You can look at your inventory over the months. January, what was your inventory level? February, your inventory level. You can put together some months, maybe a particular quarter, and divide it by 3. A quarter is 3 months. So whatever it gives you will give you average inventory you held per month in your business. So it helps you calculate your average inventory. So let's look at the example. Company G, we started from A, now we are in G. We've gone a long way. Company G has cost of goods sold of 750,000. Remember, your cost of goods sold is the amount you used in purchasing inventory. Then the average inventory is 250,000, right? Remember that you are selling and going to buy, you're selling and going to buy, you're selling and going to buy. So the cost of goods sold will keep accumulating. The inventory is being sold, so it does not accumulate. But the cost of goods sold will accumulate, just like your sales too is accumulating, right? So inventory turnover ratio will be 750,000 divided by 250,000, which is your average inventory. So that gives you 3. This means that company G has an inventory turnover ratio of 3. indicating it sells and replaces its inventory 3 times per year or per the period that you are analyzing for. You may be analyzing for 3 months. You may be analyzing for 6 months rather, and you may be analyzing for a whole year. So it shows the turnover, how quickly the inventory is being turned over, how many times they've turned over inventory to have that particular costs of goods sold. Let's move to the next. The solvency ratios. This is very, very important to your business, to the longevity of your business. These ratios measure a company's ability to pay its long-term debts. Number 1, debt to equity ratio. Total debt divided by total equity. I explained earlier about how to calculate the equity in your business. This is the money that you invested into the business and the profits that you have also plowed back into the business. We talked about this when we were talking about the kind of books where you get this particular figures from in your business. So your total debt, let's look at company H has total debt of $500,000. That's $500,000. And their total equity is $1 million. That's all what they've put into the business is $1 million. So the debt to equity ratio will be 500,000, which was the debt, the loans and all that they went to get to, run the business and whatnot, divided by $1 million. That will give 0.5. Company H has a debt to equity ratio of 0.5, indicating it has $0.50, that is 50 cents of debt for every $1 of equity. Remember that this debt that we're talking about is what was borrowed to run the business. It's not that they borrowed the money and pocketed it. They used it for the business. And the business is going to be paying back. So at the end of the day, it's going to still form, whatever they make from it is going to still form part of their equity. It's part of what they have brought into the business because the business will eventually have to pay it back, right? So that means that for every loan of 50 cents, they have equity of $1. They can easily cover up their loans. The business will not go under when it pays down its loans. Number 2, interest coverage ratio. This is for businesses that have loans. They have loans that they have to pay interest on. They have to be able to cover those interests. All right. So let's look at this. EBIT. This means earnings before interest and tax. Earnings, the profit of the business, what the business has earned before the deduction of interest expense. Interest expense could be for loans. It could also be to investors, right? Before interest expense, before interest and tax. That's taxation to the government if the business is liable to taxation. So company I has earnings before interest and tax of $200,000. And their interest expense, let's say they got a particular loan and for that loan, they have to pay interest on it of say $50,000, right? The ability of what they have earned to cover that interest is what we are calculating here. Interest coverage ratio, that's 200,000 which is their earnings before interest and tax. Remember, earnings just simply means the profit that was made before the interest is taken out, the interest from loans, interest that you may be paying to your investors before it is taken out, and before taxation is deducted from the profit made by the business. So it is not anything difficult. It is very easy to grasp. I believe you understand it, right? So you have your earnings of 200,000 divided by 50,000. Now, 50,000 is the interest expense. So this shows that this gives a result of 4. That means that company I has an interest coverage ratio of 4, indicating it can cover its interest expense 4 times over. This is fantastic. But in case, for instance, they are not able to cover this, let's say that they have earnings before interest of tax of, say, $50,000, and the interest they have to cover is $50,000. That will be 1-to-1. They can just cover it, and they are going to be in zero. They're going to be in zero, and that is not good. So these are indicators. These are indicators for your business for you to know how well the business is doing. Peradventure, you want to go into this particular thing. Is this business doing well enough? Sometimes we look at our business, well, we are at a particular stage and we think, okay, we should diversify and go this way. Diversify, let's do this one. This one will be good. This one will bring some profit. Do your analysis first. Check the health of your business at ground zero, where you are at this point. Am I able to cover some of these expenses, the expenses that I have? Am I able to cover debt? Is the business doing well in terms of profitability? Are we making enough in terms of revenue? And things like that. These indicators will help you know how well the business is doing. Is the business healthy or not? If the business is not healthy, then you will now begin to strategize, knowing exactly what and what to do, because you have calculated each one. You know what to go for. Is it revenue we need to go for now? Is it interest we need to reduce the amount of loans we are taking? Is it our inventory level we need to reduce it or increase it a bit more so that we can do better? Things like that. You'll be able to analyze better in your business, and it will give you a healthier business. And a healthy business is the one that can leverage on what they've done already to diversify and go into another phase of their business, to scale their business, to increase. Don't say, oh, I want to increase this business. I want this business to do better. I want my business to do this and do that. We should be able to do that. Let's get this loan and do it. Let's get that. Analyze it first, so that at the end of the day, you will not pick up loans that will kill the business. You will pick up loans. You will be able to use it judiciously because you already know where to use it, how to use it, how you will be able to cover it, and your business will still be strong and standing, right? All right, so we've come to the end of this class. I want to thank everyone for joining me in this class this evening. If you have a question you would like to ask concerning your business, you can go ahead. Maybe you've been doing your own calculations on the other side as well. You can let me know, what are the figures that you got? Are they good? Do you have to do better? You need strategies. Maybe you've calculated a particular thing and it's not looking like it. You want to know what and what to do about it. You can go ahead and ask your questions, go over everything again, and then use it to really check the financial health of your business. right? I want to say thank you once again, everyone, for joining me in this class, and I hope to see you again very soon. Thank you all. God bless you.